Bitcoin price hit an all-time high around $124,000 per Bitcoin, partly because of this news. All of these developments set the stage for today's main topic, and that's tokenization and how that's going to clash with TradFi. So getting into some of the depth of our discussion today, so what exactly is tokenization? It's essentially a process of taking something you can own in the real world, like shares of Apple, a U.S. Treasury bond, or even part of an office building, and creating a digital version of it on a blockchain. Well, welcome back to the Reporting Norms. I'm your host, Norm Osumi, here to break down the latest in finance, markets, and technology without an overload of jargon. It's been over 25 episodes for you that have been keeping track. Pretty amazing that we've been able to produce 25 episodes since the beginning of this year. I want to thank all of my guests that have appeared in the past. I feel that I have a special relationship with you for spending time with me on recording sessions. So thank you so much for my past guests. But today we're going to dive into a hot topic that's got Wall Street excited, Silicon Valley, my old stomping grounds, areas like Cupertino, Santa Clara, Mountain View, Palo Alto, and then regulators as well. All of these people and areas are bracing for some significant likely changes. And what I'm talking about today is tokenization. That's the idea of taking real world assets like stocks, bonds, even real estate, and putting them on a blockchain so they can be traded around the clock. We'll unpack what that means, why it's a big deal, and why it's stirring up tension between the crypto crowd and the traditional finance or TradFi crowd for short. But before we go deep on that, let's catch up on some recent cryptocurrency headlines that are setting the stage for what we're seeing in the coming months. So firstly, the SEC versus Ripple, the saga, that finally has wrapped up. The SEC essentially ended its lawsuit against Ripple Labs and the company behind the XRP token. Ripple's paying about $125 million and agreeing not to sell XRP to big institutional players without following strict rules. And for real retail investors, that's everyday folks like us trading XRP on exchanges, that will continue. This is one of the biggest legal overhangs in crypto finally that's clearing up, especially for Ripple. And just for reference, XRP has about 59 billion tokens in circularization with a value of about $3 per coin. XRP consistently holds the third largest position amongst cryptocurrencies, and that would be after Bitcoin number 1 and Ethereum number 2. So next up we have Do Kwon. He's the co-founder of Terraform Labs. He pled guilty to fraud connected to the collapse of Terra USD and Luna back in 2022. If you remember that crash, it erased tens of billions of dollars from the crypto markets in just days. I unfortunately recall putting some funds into Luna and seeing that money evaporate rather quickly. So, Mr. Do Kwon, you are facing up to 12 years of prison and forfeiting $19 million in assets. And so to provide a little background on Do Kwon, he's a South Korean software engineer turned crypto entrepreneur. He earned a BS in computer science from Stanford in 2015, then worked briefly for Microsoft and Apple before launching his own ventures. And then in 2018, he co-founded Terra Labs PTE Limited in Singapore with the aim of revolutionizing decentralized finance. Terraform Labs launched the Terra ecosystem, including the algorithmic stablecoin Terra USD and its sister token Luna, as well as DeFi platforms like Mirror and Anchor. What happened in May of 2022 is what really contributed to Terra USA's downfall, And that is because it lost its dollar peg and Luna collapsed within a week, essentially wiping out $45 billion in market value almost instantaneously. And that triggered a broad market crash. In a U.S. federal jury, or actually a U.S. federal jury, found Kwon and Terraform Labs liable for fraud, saying he misled investors about Terra USD stability. And in March of 2023, Kwon was arrested in Montenegro using falsified documents and extradited to the U.S. And as I stated earlier, he pleaded guilty in the Manhattan Federal Court, probably the SDNY, to conspiracy and wire fraud related to Terraform's collapse, admitting to the fact that he misled investors and manipulated markets. As part of a plea deal, he agreed to forfeit over $19 million, and prosecutors are seeking a sentence that's going to be capped at 12 years in prison. The next one that we have up really has fintech and financial planners really buzzing, and that's a U.S. policy that's new, and this change in this U.S. policy means that over 90 million Americans can now invest in digital assets through their 401k retirement accounts. I have some mixed feelings about that, but that's basically opening the crypto floodgates to mainstream retirement savings. Bitcoin price hit an all-time high around $124,000 per Bitcoin, partly because of this news. All of these developments set the stage for today's main topic, and that's tokenization and how that's going to clash with TradFi. So getting into some of the depth of our discussion today. So what exactly is tokenization? It's essentially a process of taking something you can own in the real world, like shares of Apple, a U.S. Treasury bond, or even part of an office building, and creating a digital version of it on a blockchain. So what is a blockchain? A blockchain is a secure public ledger and database that records all transactions. Most of you have heard of this definition already. And you also know that once a transaction is recorded on the blockchain's ledger, you can't edit or alter it. It's immutable. It's tamper-proof. It's essentially a tamper-proof spreadsheet that no one can see, but no one can modify the numbers on either. So the digital representation is of your ownership interest in that, and that is called a token. And here's the other kicker. You can trade these tokens 24 hours a day, 7 days a week, cross borders, often with fewer middlemen than in TradFi. So it's 24/7, 365 at a potential lower cost. So why are people excited? Obviously, for the two reasons that I mentioned a moment ago. But in addition to that, you have liquidity. Assets that are normally hard to trade, like real estate, can be bought and sold in small fractions, making it easier for more people to invest. That's an interesting change. The second item is speed. Instead of waiting days for a stock trade to settle, it can be nearly instant. And the access, in theory, anyone with an internet connection could buy a tokenized stock or bond, even if they live in a country without a big stock exchange. So here's really where a lot of the drama kicks in between DeFi and TradFi. And basically, TradFi is the system that we've all known for decades: B of A, JPMC, Wells Fargo, US Bank, stock exchanges like the NYSE, clearinghouses, custodians. It's arguably somewhat slow, but it's not instantaneous, but it is slower. It's regulated, and in many ways, of course, it's reliable and deemed to be stable. TradFi likes the control because it relies on trusted intermediaries to ensure that trades clear properly and that fraud is minimized and that there's a record of ownership the courts will recognize. That's all very comforting, things that we're very familiar with. But tokenization now disrupts that model by cutting out some of or many of these layers. So some or many of these middle layers are cut out, and that's for efficiency, but it also means less centralized control. And that's what makes TradFi nervous. As an example, you run a major stock exchange, you make money on trading fees, listing fees, and various services around them. If tokenized assets trade on a blockchain, you're completely competing with platforms that can operate globally without being tied to your rules or your hours. That's certainly a positive. Then there's regulation. If a tokenized share of Tesla is sold on a blockchain server in Singapore to a buyer in Argentina, whose laws apply? Is it the SEC's? Is it Singapore's? Is it Argentina's? This isn't a small issue, and it's the core reason why regulators are stepping in now. And it is also one of the reasons why cryptocurrencies has had more success or acceptance and penetration in countries outside of the US. But for investors who want trust in the system, jurisdiction matters. Why does it matter? It's because when you buy a traditional share of Tesla stock today, one share of Tesla, for example, it would be through a very well-defined framework. The trade clears through a U.S. financial system. It's overseen by the SEC. And if there is fraud or dispute, U.S. courts have clear authority. Now imagine a tokenized share of Tesla or a fractional share of Tesla that is put and traded on the blockchain. So that tokenized version is basically a blockchain version of that stock on a fractional basis. It's sold on a server in Singapore to a buyer in Argentina. Suddenly the straightforward answer of whose rules apply gets very blurry. Questions related to investor protections become unclear. For example, if someone goes wrong or something goes wrong and the tokenized share is fraudulent, who protects the investor? Is it the SEC, Singapore's regulator, Argentina's courts? Nobody. Clear jurisdiction determines whether investors have recourse or are left stranded. And then there's market integrity. That's different countries have different standards for disclosure, auditing, and reporting. Although there's some harmonization, but there's still significant differences. If a company or exchange can a jurisdiction shop, choosing the lightest regulations, it could undermine trust in tokenized markets. You have to include regulatory enforcement in the unknown. Agencies like the SEC or CFTC can't enforce U.S. laws globally. It's obvious. It's only within U.S. control. If trades move to servers offshore, U.S. regulators may have little power to stop fraud or enforce rules, even if U.S. investors are involved. Other systemic risks. So if tokenized assets grow large enough, fragmented oversight could create hidden risks. Regulators worry about a repeat situation like the 2008 financial crisis, where gaps in oversight allowed systemic problems to spread. Legal recognition of ownership also matters. Ultimately, investors want certainty. If you own a tokenized Tesla share, will a court recognize that ownership as legally valid? Jurisdiction decides whether tokens have enforceable property rights or not. On the flip side, TradFi isn't blind to the opportunity. Big players like JP Morgan, BlackRock, Fidelity are all experimenting with tokenized funds and bonds. They see that tokenization could lower costs, open new revenue streams, and reach new investors. But they want to do it inside their existing regulatory framework, which makes sense. It makes it much more efficient for them. So let's make this real. Here's an example where you have a tokenized U.S. Treasury, and they're already a thing. Some fintechs let you buy a token that represents a slice of a U.S. governmental bond, essentially giving you fractional yield as well, and it doesn't require you to open up a brokerage account. Some examples of these platforms that offer tokenized U.S. Treasury exposure are Open Eden, based in Singapore, BlackRock, and something called Realized T-Bills, which is based in Abu Dhabi. So for real property, theoretically, tokenized real estate means you could own 1/1000th of a luxury condo in Manhattan, New York, and collect your share of rental income. Tokenized stock could trade 24/7. No more waiting for markets to open at 9:30 Eastern. The potential is huge for access for retail investors, lower barriers for cross-border capital flows, and faster settlement. But with anything, there are risks of volatility. So crypto markets are known to have very wild price swings, fraud. Without proper regulation, scammers can create fake tokens or assets that don't exist. And then number 3, technical risk. If the blockchain network gets hacked or has bugs, your assets could be at risk. And under the current administration, we're seeing 2 big proposed laws. The Genius Act, which I talked about in an earlier podcast, which would set clear rules for stable coins, crypto tokens pegged to assets like the US dollar. And my previous podcast talked about the IPO of Circle, which issues the USDC stablecoin. And recall that the Genius Act, which stands for Guiding and Establishing National Innovation for U.S. stablecoins. Act of 2025 was designed to establish the first comprehensive federal framework for stablecoins, specifically payment digital stablecoins. They're basically digital assets pegged to stable values like the US dollar. Core protections and requirements include, number one, 100% reserve backing. Issuers must back stablecoins fully with US dollars, short-term US treasuries, or similarly liquid assets. Number two, transparency and reporting, regular disclosures on reserve composition, redemption policies, and for large issuers, over 50 billion in stablecoins that are outstanding. They also need audited financial statements. What are some of the consumer safeguards? Prohibitions on misleading marketing, for example, suggesting government backing or FDIC insurance. Rules to prioritize stablecoin holders in bankruptcy and anti-money laundering obligations. Senate passage. The Senate passed the bill on June 17, 2025 with a 68-30 vote. This included 18 Democrats joining Republicans in support. House passage. The House approved the Genius Act on July 17, 2025, with a strong bipartisan vote of 307 votes to 122, notable for including 102 Democrats voting in favor, alongside almost all Republicans. And Donald Trump signed it the next day on July 18, 2025, is when the Genius Act turned into and became a law. Senate sponsors of the Genius Act were led by Senator Bill Hagerty. He's a Republican from Tennessee, alongside with other co-sponsors, Kristen Gillibrand from New York, a Democrat, Senator Cynthia Loomis, she's a Wyoming Republican, and a senator from Maryland, Angela also Brooks. You'll recall that we touched on in a previous podcast that the state of Wyoming is also being very progressive in cryptocurrency and digital asset related regulations. Now, we just talked about the Genius Act. What is the Clarity Act? The Clarity Act aims to essentially define whether a digital asset is a security or a commodity. This is a much more difficult and challenging question than what was essentially posed during the Genius Act passage. But this Clarity Act is much more complicated because it basically asks the question whether a digital asset is a security or a commodity. And that matters because if it's called a security, that will fall under the jurisdiction of the SEC, while if it's designated to be a commodity, in other words, if a digital asset is considered to be a commodity, then they will be regulated by the CFTC or the Commodities Future Trading Commission. If these pass, they could give tokenization the legal framework it needs to scale in the U.S., but they might also cement TradFi's role controlling how it happens. Now, this is something that I've spoken about earlier in another podcast, but something called the Howey test will almost certainly be a major point of focus in the debate of an eventual passage of the Clarity Act. And the primary reason why is that the Howey test matters because it comes from a 1946 U.S. Supreme Court case, SEC versus W.J. Howey Company. It defines when a transaction qualifies as an investment contract and therefore a security subject to SEC oversight. The test has 4 prongs: an investment of money, a common enterprise with an expectation of profits, and primarily comes from the efforts of others. So therefore, an investment contract essentially has some money involved. It's in a common enterprise. There is an expectation that profits will be generated from that enterprise, and that activity which generates the profits is on the backs of others. If all four criteria are met, the asset is treated as a security. And for decades, the Howey test has been the SEC's basis for arguing that many digital tokens, especially those sold in initial coin offerings, ICOs, are securities. The Clarity Act directly challenges the SEC's broad application of Howey by creating new legal categories. One is called digital commodities, and these would be overseen by the CFTC. For example, tokens on sufficiently decentralized blockchains could be considered a digital commodity. Another type of category is the restricted digital asset. This is overseen by the SEC, where the tokens are sold as investment contracts or that they're dependent on centralized teams to generate that profit. This means that some assets that the SEC currently argues do meet the Howey test, that those might be reclassified as commodities under the Act, reducing the SEC reach, because if they become commodities, they would be governed and controlled by the CFTC or be under CFTC jurisdiction. So some of the debate flashpoints, the SEC's position, especially under the old chair, Gary Gensler, what he's historically argued is that most tokens are securities under the Howey test because investors expect profit from developer teams. The SEC warns that weakening Howey's application risks leaving consumers unprotected. On the other hand, the crypto industry and the CFTC's position is that industry leaders and many market lawmakers argue that Howey, which was written in the 1940s, is too vague for blockchain technology. They support Clarity's claiming that this provides certainty and avoids regulation by enforcement. What do the lawmakers view this position, or what is their position? Republicans and Democrats argue Howey is outdated and this SEC is overreaching. Progressive Democrats, what they say is that they argue Howey is a proven standard and weakening it could increase risks of fraud and instability. So the Howey test sits at the heart of the SEC versus CFTC turf war. If Howey continues to govern digital assets broadly, the SEC retains power. If the Clarity Act narrows Howey's reach by carving out digital commodities, power could shift more to the CFTC. So the debate around the Howey test will likely be one of the defining fights during the Act's Senate review and floor vote later this year, and will require further clarity on how the process of an ICO or a digital commodity is to be traded. So will tokenization replace TradFi? In conclusion, probably not anytime soon. More likely, we'll see a hybrid. Traditional institutions using blockchain technology to speed up trades, cut costs, but still keeping the guardrail regulators in demand. The real question is, who will control the on-ramps and the off-ramps between these systems? In other words, how to get off. If you own a digital currency, how do you turn that into paper money? If you have paper money, how do you turn that into a digital asset? Whoever does this shapes the next decade of investing. Tokenization promises a more open, efficient financial system, but it also challenges the very foundations of how finance has worked for centuries. Whether you see that as progress or a threat depends on your perspective and maybe your portfolio. If you found this content interesting, please like and subscribe. Thank you for listening to the Reporting Norms, and feel free to share it with a great friend. And remember to always stay transparent.